welcome to ASK Investor Managers quarterly update call on India Vision portfolio. My name is Prashant. I'll be the moderator for today's call. We'll just wait for 2 minutes for all the participants to log in. Welcome everyone to ASK India Vision and Golden Ticket Fund quarterly update call. Today we have with us Kuldeep Gangwar, Fund Manager. A brief introduction to Kuldeep. Kuldeep has more than 18 years of experience, including 15 years of experience in equity markets. This experience includes more than a decade in the sell side of equity research. His main domain of expertise is consumer sector, FMCG and retail. Prior joining to ASK, he was associated with HSBC Securities and Capital Markets. He's also worked with Tata Motors for more than 3 years. He's done MBA in finance from IIT Bombay, and he's done his BTech in electronics and communication from IIT UK. He is CFA charter holder and he's joined ASK in 2018. Welcome Kuldeep to the call. I would request you to take us to your market outlook, update on the portfolios. At the end of the session, we'll have a Q&A. I request the participants to type their questions in the Q&A box. Over to you, Kuldeep.
Thanks everyone for joining in. Good afternoon. So before coming to say portfolio or our own economy, it also matters that the global ecosystem, global indicators, because they do play a role in the say overall portfolio performance. So if we think about global indicators, first of all, the global market performance. So India had been one of the better performers. If we look 1 year, 3 year, 5 year, there was some uncertainty in the calendar year. There's a reason it has done well, but they had been better performer if we look globally. If we think about, say, what matters for our country, like we are the net importers of the crude oil, and its movement does matter because it's having implication for, say, how current account deficit would be, how the currency would behave, and so on. So you will recall, like almost 2 years back when the Russia-Ukraine war broke out, at that time, say crude moved to almost $120 per barrel and more than that number. And then there was a cooling off. After that, the Israel war started. Then again, boiling of the crude oil. And after that, again, the settling of the number. Net crude oil is relatively stable, vis-a-vis say what we have seen a couple of years back, and which is a good news for us overall. Crude oil, etc., are also having implication for, say, global inflation and the global interest rate. And those things do count when we think about the equity markets. So if we think about, say, US Fed rate movement from almost September 21 till last year, there was only upward movement because most of the central banks were responding to increase in the inflation. And after that, there had been a pause. And they is await that when the interest rate will start coming down. So as a first development, last week, European Central Bank has cut the, say, interest rate by 25 basis point. It happened after almost 5 years, like first cut happening after 2019. And more so, they were raising the interest rate till September 23. So it's a welcome development. And hopefully, the rest of the central banks, whether it's a US Fed and other central bankers, should also cut the interest rate in the due course of action. So decline in the interest rate is a good news for the equity overall. And it's even better news for, say, growth economy, growth sectors, and the growth stocks. And particularly our style, we are having a positioning of high quality and high growth. So the interest rate movement do matter. And when there is a cut, it's a better news for the overall growth style per se. If we think about domestic backdrop, so we have seen that election results have come last week. They were below expectation, current dispensation has come back, but the number of seats were lower. And there is some wait and watch, the shape of the government, how the budget would be, what would be the priorities, and so on. We believe there can be the short-term market and stock-specific movement, which can be accentuated by domestic and FII flows. In terms of the news flows, people will be looking for the monsoons. People will be looking for how the interest rate action is happening by different central banks, and obviously the geopolitical challenges which are being faced on the ongoing basis in the last 5-6 years. So the way we think about it, like policy continuity likely to remain at the broad level, and India should remain a long-term destination as far as the fund flow is being concerned. From the macro perspective, the strong GDP growth in FY24, like almost 8.2% YOY, with a 7% growth experience in FY23. And RBI has given a forecast for next year as well. So in FY25, the expectation is the GDP growth should be more than 7% again, which is a good news. When we think about inflation, it's a 5% in FY24, and expectation is that this number should come down to 4.5% in FY25. Net, we will like to believe that in FY25, it should be a combination of strong growth as well as relatively more controlled inflation. And at some point of time, the RBI should cut the interest rate as well. If we think about corporate earning performance, FY24 was good for the overall Nifty, almost 25% plus earning growth. And we expect FY25 and FY26 should have a decent double-digit earning growth. Q4 FY24 earning review, at the overall say market level, there was 11% plus earning growth, and our portfolio did better than that particular number. Domestic cyclicals like auto, real estate, capex-driven businesses, and BFSI continue to deliver superior earning. There were some challenges, particularly in the energy, metals, and IT sector, some on the expected line. If we think about FY25, so FY24 base is quite strong, and there are the ongoing concern which we come across, like geopolitical situation, and seemingly premium valuation, as well as slightly lower earning growth vis-a-vis, say, FY24. So the way we think about it, the acceleration in the government capex, which was done in last couple of years, should continue. But at the same time, there should be some acceleration in the private capex as well. On the same monsoon front, which is a key factor as far as the rural economy is being concerned, the rural income is being concerned, La Nina onset is a positive news. Expectation is that there would be the normal monsoon, and which should lead to good crop and good rural recovery as well. If we review how the FY24 had been, so there were certain components of the overall portfolio which did better, like manufacturing, auto ancillary, building products. They delivered quite healthy return. There were other, say, components like telecom and beverages also did well. At the same time, there were, say, certain sections like chemical, consumer discretionary, which did not yield the results which we were seeking. And there was some underperformance on account of lower exposure toward the PSUs. It may be PSU bank, it may be, say, capex driven business, and so on, till the first half of the last financial year. If we think about, say, overall PSU, how dominant this factor was, in about 24, the PSU had risen almost 89%. And though they accounted for only 10% of the weight, you can understand that BSC 500, almost quarter of our performance have come from the PSU, just because of the strong return they have given as a pool. We have tried to make a certain correction in the portfolios in the last 6 months. Like left-hand side reflect the entry which we have done in last 6 months, whether it's a defense, like Bharat Electronics, then the power industries in the manufacturing, L&D in the construction, IOC in the oil and gas, REC, SBI in the PSU space. Then there is Adani Port, Titagarh, and so on. So we have tried to increase our exposure towards, say, infrastructure, manufacturing, defense, and so on. At the same time, we have made certain exit, particularly from the private banks, some of the consumer names, to make the space for these manufacturing related names. And these changes have started yielding result, and more so in time to come. We expect that they should deliver healthy performance both on earning side as well as the stock return side. And what we have done in last 6 months, it's not restricted to last 6 months. It's a journey. If we look last 4-5 years, we are constantly increasing the exposure toward the infrastructure and engineering. Like it was almost negligible exposure till CY 20, and since then we are increasing exposure and almost 17% plus as on December 23. And as we speak, this number has already increased to close to 25%. So as an overall action, we are bringing down, say, consumption and financial. At the same time, we are increasing the exposure of, say, infrastructure, engineering, capex, capital goods, and so on. So the way we think about it, like in pre-COVID scenario, the consumption and financial used to offer more structural compounding opportunity. And post that era, there are incremental opportunity coming across the board. And that's the reason this particular portfolio is emerging more like a more broad-based, say, representative of India economy story, rather than restricted to certain themes. This is how the portfolio appear as on May 24. Like almost 27% is coming from, say, manufacturing, defense, capital good, and construction. Significant overweight position vis-a-vis, say, BSC 500, where these say segment contribute almost 13%. We are relatively underweight on the financial side, like almost 21% of the portfolio coming from there, vis-a-vis BSC 500 might be having close to 27%. Consumption, we are overweight, and most of we have increased, say, some exposure towards a beverages sector, like we introduced Varun beverages some time back. So it's an overweight position again, and which should benefit from, say, increased focus on the consumption in time to come. In telecom, Bharti has done quite well, and we introduced Bharti partially paid as well. As I mentioned, that ports had been entry 6 months back. We have made a switch from, say, JSW Infra to Adani Port. And again, there are the other areas like oil and gas, etc. At the same time, we have brought down our chemical exposure, because this sector is facing some challenges, and near term, obviously, there is weakness across the sector. This is the wheel, like we suggest that quite diversified across different themes within the overall economy. So it moved from from engineering, FMCG, oil and gas, and so on. So it's a quite broad-based portfolio as far as the India vision or the golden decade is being concerned. From the market cap perspective, 2/3 of the portfolio is having the large cap exposure. Balance is split between, say, mid cap and the small cap. If we think about earning growth, so overall portfolio earning growth had been quite strong, like 5-year CAGR had been 25% plus, vis-a-vis 16% CAGR for the Nifty. And we expect this should continue. Like in FY 24, last quarter, there was almost 15% operating profit growth, vis-a-vis say 11% for Nifty 50. And for FY25 and FY26 as well, we expect close to 20% plus operating profit growth, vis-a-vis say a low teen number for the overall Nifty. So valuation perspective, the trailing valuation have come down. Earning growth remain quite strong. And that's the reason it's a good combination of a strong earning growth and the reasonable valuation. This is a snapshot like how the valuation metric is performing. So today as we speak, valuation perspective, it's on the lower side. So theoretically, the strong earning growth should translate into the stock returns as well. This is a snapshot of the performance in last 1 month and 2 months. We have made some of the changes which we have done in last 6 months. They have started yielding good result. So things have started coming back, and more so we believe that the portfolio is more aligned in the areas where a lot of action will be happening, a lot of growth will be happening. And as and when it happens, in due course of time, that earning growth should deliver the strong return as well. If we think about stock contribution, so last 1 year, Polycab, Patanjali, Bharat Electronics, APL Apollo, Bharti Airtel have delivered quite strong return and contributed to the overall portfolio return. At the same time, there had been certain deaths, and we have exited some of those names like AU, SRF, Page Industries, we have exited. In case of Naveen, we believe that probably the worst is over and the earning growth should rebound here onwards. So I will stop over here and will be happy to have any question which you might be having.
Participants, I request you to type in your questions in Q&A box. Meanwhile, Kuldeep, we have curated some questions. The first question to you is that you have reduced the exposure to banking to 3.9% from 10%, and you added more of capex.
Yeah.
Any specific reason you look to reduce, especially in banking?
So it's more about creating liquidity for the area where a lot of growth will be coming. So ultimately, we have to split the $100. And we do believe this infrastructure, manufacturing, railway, defense, all those areas should continue to deliver strong earning growth, not only for say about 25 and about 26. We believe they have years to come to deliver that strong earning growth. That's the reason we have done it. From say earning growth perspective, say banking was doing reasonably well, and we believe that they can deliver say low to mid-teen earning growth. But at the same time, it's always a trade-off. Like we look for the relative risk and return, and we believe that shift was a must-have, and that's the reason we have made this particular change, like moving more towards that capex-related name, vis-a-vis say banking overall.
Yeah. So in continuation to this, you still prefer NBFCs over banks.
Yeah.
Any specific reason for that?
So the way we think about it, like in terms of name, if we think about say overall margin, we believe that NBFCs are relatively better placed vis-a-vis say banking portfolio overall, because lending rate should be relatively more resilient in case of NBFC. And if we think about whether it's a Chola or for that matter REC, etc., they are a strong tailwind, and it's coming from different areas. Like in case of Chola, auto is doing quite well. In case of say REC, if we think about it, like it's a proxy of say how the power capex will be happening in our country. So it's a combination of two things, like almost 20% plus say loan growth translating into the similar sort of revenue growth, and equally strong say earning growth over there. At the same time, the valuations are quite reasonable. So it's more about a shift towards a higher earning growth at relatively reasonable valuation. So there are certain tailwind in case of say NBFCs, etc., being concerned. That's the reason slightly high tilt in the favor of NBFCs over there.
So in continuation to this, Bajaj Finance still not to the expectation what we look from the stock. So when do you see this coming back?
So if you think about Bajaj Finance, as far as the earning growth is being concerned, this company is delivering earning on the ongoing basis. Like there are very few companies which are delivering say 20 or for that matter 25% plus earning growth. What happened in last 2 to 3 years, there had been significant derating happening, not only for Bajaj Finance, it was happening all across the BFSI sector. So it had been the case with all the private banks to say so, whether it's HDFC Bank, Kotak Bank, and so on. And same had been the case with say Bajaj Finance. So it's not about say companies not able to deliver earning. It's more about how much appreciation is given to that earning. We believe that today, at the current juncture, the valuation have become quite reasonable for this particular say company, and earning growth should remain quite strong for at least next 5 years or so. So at some point of time, that 20-25% earning growth should translate into the decent return. At the same time, from the risk control perspective, what we have done, like earlier, the Bajaj Finance and Bajaj Finserv combined exposure used to be 10% plus. We have brought down the exposure of Bajaj Finserv. Because if we think about Bajaj Finserv, again, a large part of the valuation comes from the Bajaj Finance itself. So net, we have tried to reduce some exposure in the twins and redeployed that particular exposure in the names which we discussed earlier, like manufacturing, capex, and so on. So we remain confident that the earnings are there. At some point of time, the appreciation of the same will also happen. But from the risk control measure perspective, we have brought down the overall exposure towards the group.
Thank you, Kuldeep. You added Titagar stock to the Titagar rail system. Your view on the stock, and do you think it is currently expensive?
So Titagar, generally people try to look like how the railway used to be 10 years, 15 years back. But the way we think about it, it's a structural change happening in that particular area. The companies are having a lot more visibility vis-a-vis say past, like 10, 15 years back, when the wagon number used to be announced by the government, it used to be limited to a particular year. Now, when the government is making announcement, they are doing for 3 year, 5 year in a single lot. So a lot more visibility has come, and multiple engines have come as far as the growth is being concerned. Earlier, it used to be only freight and related engines or related say wagons, but today it's more about passenger wagon as well. Like they are doing say metros, they are doing say Vande Bharat, and so on. And the prominence of the same will continue to increase. Like FY26, there will be a strong transition when it will be a transition from freight to passenger. And if we think in the interim, the company is working at significantly higher capacity utilization on the expanded capacity. So for this year or next year, the freight wagon should help. And for years to come, the say Vande Bharat order, etc., gave multi-year visibility. As far as the growth is being concerned, we remain quite hopeful that this particular sector and some of the companies which are leaders in this particular domain, like Titagar is among the leading company over there, should deliver more than 25% earning growth for a medium term at least. So it's more about a combination of long-term visibility coming into the sector, then a relative dominant position over there. Third, it's a say quite diversified portfolio, like combination of say both freight as well as passenger. And when we think about passenger, it's a combination of again metro and something like Vande Bharat and so on. So all these things give a multi-year visibility to us, and that's the reason the exposure is being taken in that particular area.
Kuldeep, there is one question. While the changes have worked for 1 month, 3 months, and 6 months, when do you see the gap narrowing down with the long-term performance of GDF?
Yeah, so I alluded to this particular part, like from September 21 till last year, it was a one-way journey when the inflation was higher and interest rates were rising. And the quantum of change was so drastic, like what probably we have not seen in decades. And whenever this interest rate upcycle happen, it's having implication for growth sector and growth stock and growth as a style as far as the equity investing is being concerned. And so it was not about earning growth, like whether it's FY24 or prior year. I already mentioned that earning was coming year after year, but at the same time, it did not translate into the stock return because there were concerns related to interest rate, etc. Today, as we speak, as I mentioned, that first interest rate cut has come from European Central Bank last week, and more of the same should happen in, say, coming months or coming quarters. As and when it happens, then there would be appreciation of that earning growth. This is something we are confident about. And as I mentioned, that we are doing a lot of alignment. Multiple changes are being done in last 6 months. And as and when further changes would be required, it will be done. Some of those changes have started yielding the result. And as long as earnings are there, the stock returns have to follow sooner or later. This is what we believe in. So this gap should close. As long as the companies are delivering, and we don't have any doubt the companies can't deliver, can't deliver. This is the consistent and the constant factor as well as the portfolio is being concerned, that the earning growth was coming on the ongoing basis.
Thank you, Kuldeep. Kuldeep, you have added a stock called Apar Industries. Your view on that?
So Apar is having 3 engines like conductors, transformer oils, as well as cable. And they have very strong position in all the 3 areas. So if we think about conductors, like when there is a revival in the power sector, there's a revival in, say, T&D, basically the transmission and the distribution within the power. Then railway capex is picking up, the conductors would be required. So again, a derivative or say a proxy of the capex over there. If you think about, say, transformer oil, another area where, say, this company is having very strong position. So transformer oil should benefit again when infrastructure, transformer sector doing well. And third, quite dominant position in, say, renewable cable, like whether it's a solar or wind cable, they have a very strong market share. In fact, the cable has grown almost 23% CAGR in last 10 years. So net, if you think about Apar, they had been beneficiary of say capex reliable, not only in India, but globally. They are among the largest exporter of the, say, cables as far as Apar is being concerned. So the way we think about it, like all the 3 sectors should fire, particularly the cable one, and revenue growth should be close to mid-teen, but there is a scope for the margin expansion. And that's the reason the earning growth should be quite robust. It may be, say, 25% to 30% CAGR for a medium term. So this is about capex, and this is about Apar. Both are interlinked to each other.
Thanks, Kuldeep. Kuldeep, with the new government coming in, and then do you think they will continue to do these bold reforms? That is one. Second, there is a feeling that they have not done much on the social welfare schemes. So if they start doing that, do you think there will be an impact on the capex, on the expenditure overall? And then if they continue to have the fiscal prudence, what is that they going to, are they going to reduce the allocation to others? Or do you think that they would not do and continue with the reforms as such?
So obviously, post-election results, there had been some doubt in different quarters. But if you're listening to the commentary which is coming from, say, Mr. Modi, then one thing is for sure, that the capex is unfinished agenda. It will continue to happen. And in his first, say, discourse, he mentioned 3-4 things, like he mentioned about defense, he mentioned about, say, green energy and so on. So we do believe there should be the policy continuity, and there should be the ongoing agenda of capex. Second question regarding, like, what about the other areas? The way we think about it, it would be a balance, and obviously there are some options available. Like if we are keeping a note of it, then RBI announced 2 lakh plus crore dividend, and it was much higher the number vis-a-vis what was probably budgeted 2-3 months back. Therefore, it provides the cushion, like this incremental windfall can be deployed in different areas. It may be capex, it may be, say, some social related issues, it may be area bringing down the debt. So government will do as and when they feel like whatever is the necessity. if you look the first, say, action by the government, they have signed close to 20,000 crore related to, say, farmers payout over there. So I don't think it's a one versus another. Both will go hand in hand, and fiscal prudence will continue to happen. At the same time, like whatever the good work they have done, the results of the same should be visible in the time to come. And even if they do not use this incremental windfall from the RBI towards the capex, even in that case scenario, and we are talking about pretty healthy growth in the capex on like-to-like basis. So we remain quite optimistic that it's not one versus another. Both may coexist, and capex related theme, whether infra, say, manufacturing, capital goods, should continue to deliver strong earning growth.
The next question is on Sai Silks. Sai Silks has been, from the time it's been added, it's not been doing well. So your view on the stock?
So Sai Silk, we took close to IPO time, and in between the stock had a good run up, like it moved to close to 300 plus. We had trimmed our position. As we speak, the weight of that particular exposure will be close to 1%. And we do believe that what happened to SciSilk, it actually happened to most of the consumer discretionary names. Like there was a slowdown across, say, consumer discretionary names in apparel, in retail, in footwear, in, say, QSR, and so on. The way we think about it, like companies should start delivering pretty strong earning growth from Q2 onward. Like it's a combination of two things, like broader macro get stabilized, as well as its own retail expansion start yielding the result. So we are quite hopeful that from Q2 onwards, there should be strong recovery of earning. At that particular point of time, we will take a call, like whether it's in line with expectation, how the things are evolving. Net, the stock is quite cheap. Like in FY25, we expect close to 10 rupee EPS. In FY26, the number should be close to, say, 15 plus. And that way, the valuation is close to, say, 12 PE for FY26. It's among the most inexpensive stock available in the consumer discretionary stock. At the same time, we remain watchful because it's a new listing, and they have to deliver the result. So based over, say, development from Q2 onwards, like it's a delivery with a expectation, we will take an incremental call. As we speak, the exposure towards the side silk is close to 1.2% in the overall portfolio.
Next question, you exited JSW Infra and added Adani Ports. So your view on that particular stock?
So first of all, we are positive on both the name. Like we added JSW Infra post, say, IPO last year from September 23 onward. And that particular inclusion gave quite a strong result to us, both in terms of earning growth as well as stock return. So what happened interim, like there was sharp run up in that particular company. And what we did, like we make a switch from JSW Infra to Adani Port. We are confident about, say, volume growth, earning growth for both the companies. Both should be the beneficiary of, say, ongoing infra, say, thrust in this particular country. So earning growth should remain quite strong for both the company. At the same time, Adani Port was available at relatively more reasonable valuation. So if we think about, say, JSW Infra, about 25, it might be 45 PE, vis-a-vis, say, that say Adani Port is available close to 40 to 45% discount. So it's more of a valuation call, like we have booked the profit in one particular name. We remain quite positive about the overall theme of, say, infra, support, and so on, logistic. So we wanted to have that exposure, and that exposure was available at relatively lower valuation. That's the reason we have made this particular switch.
Kuldeep, there is one question on Make in India manufacturing equipment companies. What kind of exposure do you have in your portfolio?
So the way we should think about it, sometimes we may have direct, sometimes we may have the proxy exposure. like if any sort of manufacturing is happening, capex is happening, industrial capex, residential capex. So there are two ways. We can have the direct exposure, or we can have, say, some proxy of the same. So we have Polycab in this particular portfolio. So Polycab is representative of any sort of industrial capex happening in this particular area. Same as we discussed about, say, APAR industry, again the proxy of, say, manufacturing in this country. So at time we may have, say, direct play, at time we may have, say, indirect. Net, we have to capture that particular theme. And I mentioned that as we speak, almost 25% plus of the portfolio is coming from those particular areas.
Thank you, Kuldeep. Participants, if you have any question, please type in the Q&A box. Kuldeep, I think, okay, one of the questions is on update on Patanjali stock.
Yeah. So Patanjali, if you look, we have discussed in past that the company is going through a transformation. Like if we think about the business of Patanjali 3 years back, it was more of a commodity business like edible oil. And when there had been a transfer of business from the parent, like Patanjali Ayurveda, the more predictable, high growth, high margin business came to the fold. Basically, we are talking about the FMCG part of it. Today, as we speak, that almost 30% revenue and almost 90% profit is coming from that particular segment. It's happening at the time when the edible oil had been quite volatile. If we think about 25, we believe that both the engines should deliver, like edible oil operating profit should come back. FMCG should continue to deliver healthy top line growth as well as, say, earning growth. And there can be the third element, like a company has filed, say, with the exchanges that there can be further non-food business transfer from, say, parent group to this particular company. As and when it happens, a large part of the EBITDA prospects will be linked to, say, non-commodity part. So we remain quite hopeful that there should be significant acceleration in the organic business of the company in FY25 and beyond. At the same time, there is scope for transfer of, say, non-food business from, say, parent to the listed entity, which should provide the boost to the overall earning growth in time to come. And that is something we are looking for, like what is the revenue, EBITDA, and the valuation for upcoming transaction. And probably that can be a catalyst in time to come. Net, even in isolation, the valuation is quite attractive after factoring in the strong earning growth expectation in FY25 and beyond. And after this transaction, like this personal care business coming to, say, listed entity, a lot more diversified company, a proper, say, consumer company on its way. So which should further yield, say, stability of the earning growth and increase the attractiveness of the company.
Okay, one last question, Kuldeep. There's a 8% exposure to oil and gas. What is the rationale and what is the growth potential?
No. So you should look like 4% is Indian Oil and 4% is Reliance. Reliance today, though it's being classified as oil and gas, it's primarily the telecom and the retail story. So in valuation, almost 70% plus would be coming from, say, telecom and say retail part of it. So from pure play oil and gas exposure perspective, it's only Indian Oil, which is close to 4% of the business.
Thank you, Kuldeep. We do not have any more questions. Your final remarks for the closure.
So, as I mentioned, like we have done many changes in last 6 months to align the portfolio in the direction where a lot of action will be happening and strong earning growth would be coming. And those changes have started yielding decent result. And we are hopeful that as long as this CapEx agenda is on track, earning is coming. It has to translate into the decent stock return as well. With that, I will close the presentation as well.
Thank you, Kuldeep. Thank you, participants.
Thanks, everyone. Have a good day.
Thank you.